company is a separate legal entity from its shareholders. However, it is taxed in a similar way to individuals, meaning we need to determine the assessable income and allowable deductions in order to work out taxable income. Determining a company's taxable income will initially involve making a number of adjustments to the company's accounting profit and loss. This process is required where the accounting and tax treatment of a revenue or expense item differs. The differences may occur due to differences in legislation and accounting treatment. Tax payable on taxable income is levied at a flat rate without the benefit of any tax-free threshold. Tax offsets such as franking credits typically reduce the net tax payable. Consider Oxley Proprietary Limited, a resident private company. What is the taxable income and tax payable for Oxley for the current tax year? It is evident that both franked and unfranked dividends have been received from resident public companies. The treatment of the franked dividends requires the dividends to be included in assessable income along with a gross-up of the franking credit. The gross-up and credit approach is part of the simplified imputation system. The maximum franking credit allocated to the distribution from the resident public companies is calculated according to Section 202-60, subsection 2. The unfranked dividend is not grossed up and is included in assessable income directly. For the interest income, we note that it was subject to 10% withholding tax, which also requires it to be grossed up for that amount and included in assessable income. Corporate tax entities are entitled to a tax offset equal to the amount of franking credit included in their assessable income to prevent double taxation of corporate profits. The company is also entitled to a credit for the withholding tax paid on the overseas interest income. It should be noted that once companies lodge their tax returns disclosing details of their taxable income, the Commissioner of Taxation is deemed to have made an assessment on the date of lodgement, and a notice of assessment is deemed to have been served. To recap, when calculating income tax for a company, you must first determine any adjustments that might be required to the accounting profit or loss. Franked dividend income, or income from which withholding tax has been deducted, must be increased by the amount of the franking credit or tax withheld, and the appropriate adjustment made to assessable income. The company will then be entitled to tax offsets for these amounts, which reduce the net tax liability.